economy for financial services.
In July 2009, I said that much of finance was socially useless. But I also became increasingly convinced as I thought about why it was so difficult for the global economy to recover from 2008, that although that overexplosion of financial innovation and trading was undoubtedly a problem that we should try to get rid of, that the even bigger problem derived from some things which, in a micro sense, looked at each loan by loan, might be socially useful, but in total had a harmful macroeconomic result. The crucial part of my argument looks at the growth of debt. This isn't the intra-financial system debt, which John has talked about. This is real debt owed by the real economy, households and companies, to the financial system. In the advanced economies, in total, in 1950, that debt level was 50% of GDP. By 2007, it was 170% of GDP, and it grew pretty much every single year from 1950 to 2007, and at an accelerating pace over the final 20 years. When that growth of debt occurred, it produced very little concern among finance theorists, who were basically much more worried about some countries in the world that didn't have enough debt rather than too much debt, and very little concern among monetary theorists who had developed a set of theories that said that you could ignore the details of the financial system. We tend to say that banks take deposits of existing money and lend it on to entrepreneurs and businesses funding capital investment in the real economy. Unfortunately, I have to tell you that both elements of that statement are completely wrong. Banks don't just take existing money and lend it on. They create credit, money, and purchasing power that did not previously exist. And that is fundamental to how the macroeconomies works. They lend it very significantly to consumers to bring forward consumption, but even more than that, they lend against real estate. And it turns out that this has some major implications, because if banks can create more credit and money and purchasing power, and if they primarily lend that against existing real estate which already exists and which you can't rapidly create more of, then you unleash these amazing cycles of more credit produces higher asset prices, produces more credit. And this then eventually blows up. And if the economy already has a high level of debt in place, we enter an environment where the debt doesn't go away, it just shifts around the economy from the private to the public sector, and where all our policy levers for keeping demand in the economy going are either blocked because we've got too much public debt, so we don't think we can run fiscal deficits, or are ineffective because we cut the interest rate to zero, but if people have too much debt to start with, they don't respond to that. Why has the last 8 years since 2008 been a period of such slow growth and low inflation, despite this enormous monetary stimulus of low interest rates, zero interest rates, negative interest rates, QE? I think the fundamental problems are too much debt. I think we need a completely different approach to the combination of monetary policy and regulation. I don't think that we can simply control our economies as the central banks before the crisis believed by saying we'll use the interest rate and we'll have one objective, low and stable inflation. Because actually what we learned before the crisis is you can achieve the objective of low and stable inflation but still produce a complete disaster. I think we have to pay attention to how much total debt there is in the economy and to the balance of that debt. I also think we need a completely different approach towards the regulation of the banking system. And